The Outsiders, 8 Unconventional CEOs Introduction. If you're asked who the greatest CEO of the last century was, one name might naturally come to mind: Jack Welch. During his 20-year tenure as CEO of GE from 1981 to 2001, GE stock had a compounded annual return of 20.9%. $1 invested in GE stock in 1981 would have turned into $48 20 years later. As a result, Jack Welch has been lionized as the classical power CEO. He was a famously active manager, diving deep into business units and traveling among GE's locations. He communicated regularly with Wall Street and focused intently on managing GE's stock price. He earned a public persona as a charismatic high-performance manager, gracing the covers of business magazines and authoring management books like Winning. But is Jack Welch really the greatest CEO of the century? According to the author of The Outsiders, no, not even close. There are two common issues with assessing the performance of CEOs like Jack Welch. 1. The macroeconomic context greatly affects stock price. Therefore, the performance of the CEO needs to be compared relative to the rest of the market, namely, returns of peer companies and of the broader market over the same period of time. If a company can outperform its peers consistently, this suggests a real difference in managerial abilities rather than in the external environment. Jack Welch ran GE during one of the greatest extended bull runs in U.S. stock market history, during which the S&P had a 14% annual return. In this context, Welch's performance, while still impressive, is less distinguished. 2. People disagree on the metric by which CEOs are compared. Often, the business press emphasizes vanity metrics like growth in revenue or earnings, or total headcount. The author argues this would be like fixating on the tallest NBA players, or the heaviest football linebackers. In reality, only one metric in business really matters: the company's per-share value. Taking these 2 points into account, there are CEOs that outperformed Jack Welch by multiples. For example, Henry Singleton of the conglomerate Teledyne operated during a 30-year period when his peers were returning 11% per year. In contrast, Teledyne returned 20.4% in the same period. $1 invested in Teledyne at the beginning of the period, 1963, would have returned $180 by 1990, compared to $27 in a basket of conglomerates, or $15 in the S&P 500. Singleton achieved 5 times better performance relative to peers, in a worse time that featured multiple bear markets. The author investigated CEOs like Henry Singleton, who had outlier performance compared to the rest of their industry and the market. He found 8 CEOs whose companies showed remarkable financial performance over the course of decades. Furthermore, he found uncannily strong patterns among the outsider CEOs that distinguished them from typical CEOs. These CEOs and their management practices are the subject of The Outsiders. The Outsiders, 8 Unconventional CEOs. Chapter 1, Tom Murphy in Capital Cities Broadcasting. Capital Cities Broadcasting was a media company owning television stations, radio stations, and print publications. Outsider CEO Tom Murphy was CEO from 1966 to 1996. In 1966, the market capitalization of Capital Cities was 6% that of CBS, the dominant media business in the country. By 1996, when Capital Cities sold to Disney, it had rocketed past CBS and was now worth 3 times as much as CBS. It had acquired media giant ABC, which was dubbed by the press as akin to a minnow swallowing a whale. Relative to CBS, Capital Cities had grown nearly 50 times as much in the same period. The strategy was simple and repeatable: buy media properties with attractive economics, improve operations to generate more cash, and use the cash to buy more media properties. Capital Cities had a management playbook that made it very effective at increasing revenue and cutting costs at its newly acquired companies. This created a perpetual motion machine for returns. New section, Performance. From 1966 to 1996, Capital Cities showed a 19.9% annual return rate, compared to the 10.1% for the S&P 500 and 13.2% return for leading media companies. $1 invested at the beginning would have been worth $204 by 1996. This outperformed the S&P by 16.7 times, and his peers by almost 4 times. New section, History. Tom Murphy served in World War II and graduated from Harvard Business School in 1949. He worked as a product manager in consumer packaged goods for Lever Brothers until 1954, when his father's friend Frank Smith told him about a TV station in Albany he'd purchased from bankruptcy. With no broadcasting experience, Murphy left to run the station day-to-day, with Smith running the business from downtown New York. Murphy's strategy was to improve programming to raise revenue and manage costs to reduce expenses. After a few years of losses, Murphy turned the station into a profitable cash generator. In 1957, they bought a second station in North Carolina, then a third one in Providence, and continuously from then on. When Smith died in 1966, Murphy became CEO of Capital Cities. Murphy in turn promoted Dan Burke, a Harvard MBA he had hired 5 years earlier, to COO. They had a clean division of labor. Burke would focus on the day-to-day operations, while Murphy was responsible for capital allocations and acquisitions. In essence, Burke generated the free cash flow, and Murphy spent it. At the time, Capital Cities had revenues of $28 million. Over the next few years, Murphy made large acquisitions. In 1967, Murphy bought a Houston ABC affiliate for $22 million, then the largest acquisition in broadcast history. In 1968, he bought Fairchild Communications, a trade magazine publisher, for $42 million. In 1970, he bought broadcaster Triangle Communications for $120 million. At the time, the FCC allowed a company to own a maximum of 5 VHF TV stations, and Capital Cities had reached this maximum. Thus they turned to newspaper publishing, which had a similar business model as broadcasting. Once again, he had an appetite for acquisitions, buying newspapers for values in the high 8 figures in the 1970s. In 1980, he entered cable television by buying Cablecom for $139 million. During the bear market of the early 1980s, Capital City shares were at single-digit PE, price-to-earning multiples. Murphy aggressively repurchased Capital City shares, eventually buying back close to half of standing shares. In 1984, the FCC relaxed its maximum station limit, and in 1986 Capital Cities bought the ABC network for $3.5 billion, with financing help from Warren Buffett. As the largest transaction in business history outside of oil and gas, it stunned observers. ABC was bigger than Capital Cities at the time. But Capital Cities treated ABC no differently than small local stations it had acquired. It cut costs aggressively, including ABC's plush executive perks. It improved programming, in turn leading to better ratings and revenues. Soon ABC became more profitable than its competitors CBS and NBC. In 1993, at 65, Burke retired from Capital Cities. Now without a clear successor, Murphy met with Michael Eisner, CEO of Disney, in 1995, who was interested in buying Capital Cities. Murphy negotiated a $19 billion price, which was 28 times net income. New section, Management Practices. Financial Practices. As a prototypical outsider CEO, Murphy rarely issued stock to fund acquisitions, which would dilute existing shareholders. Instead, he raised debt to fund acquisitions. Since Capital Cities enjoyed industry-leading margins, he would often pay off debt ahead of schedule. Then, with the new profitable asset, he would leverage it to buy other assets. This was a highly repeatable strategy that they employed dozens of times over Murphy's tenure. Capital Cities also repurchased $1.8 billion of shares, mostly at single-digit ratios of price to cash flow. Focus on core businesses. When acquiring companies, Capital Cities focused on businesses it knew it could run well, media businesses that it could buy, make more efficient using its operating playbook, and thus turn into productive assets that could fuel further similar acquisitions. They knew the business model well: advertising-driven revenue with good margins and strong competitive barriers. In contrast, its peer company CBS engaged in the conventional practice of acquiring unrelated businesses, such as toy businesses and the Yankees baseball team. The conventional thinking was that these acquisitions would lead to diversification, thus avoiding the variability of economic cycles, as well as synergies, where larger companies magically become more profitable through efficiency. However, like many acquisitions by conglomerates of this era, these did not materialize in meaningful synergies or better profits. Often, conglomerates acquired too rapidly and underestimated the difficulty of improving operations to realize cost efficiencies. Acquisition style. When acquiring companies, Murphy prospected carefully for good deals. He had a simple benchmark: the acquisition should have a double-digit after-tax return over 10 years without leverage. He was known for being fair. He'd ask the seller what a fair price was, and if he thought it was fair, he'd pay it. If he didn't, he countered once. If rejected, he walked away. He never engaged in hostile takeovers. Often, the reputation of capital cities preceded him. They were known for being market leaders and fair employers. This lowered the hesitation of potential acquisition targets. Decentralization. Capital cities strongly believed that the best decisions were made at the local level. Headquarters gave responsibility and authority to individual publishers and station managers. As a result, its headquarters was tiny. It saw its role purely as supporting the general managers. There were no vice presidents in functional areas like strategy or marketing, and no PR department. This drastically reduced overhead, contributing to capital cities having the highest margins in the industry. In this environment, entrepreneurial general managers thrived. Managers were expected to deliver margins and to outperform their peers. If they met their numbers, they rarely heard from headquarters. High-performing managers were trusted to take over a newly acquired business or to enter a new industry, even if the manager didn't have prior experience in the industry. Lean operating expenses. Businesses that rely on advertising face variability in revenues, often as a result of the larger economic environment. Capital cities knew that their businesses couldn't control revenue, but it could control costs. Therefore, they cut wasteful expenditures aggressively, particularly around headcount and perks. In a famous story, when Murphy first arrived in Albany in 1956, Smith asked him to paint the TV station's exterior to look better to advertisers. Murphy painted only the two sides facing the road, leaving the other two sides the same. This spirit carried throughout Murphy's management. Each year, every general manager prepared detailed budgets for the upcoming year and met with Burke and his CFO at headquarters. Burke would go line by line and scrutinize each expense. When capital cities acquired ABC, they immediately cut unnecessary expenses like executive limo service, and they laid off 1,500 redundant positions. Choice investments in product. Despite their philosophy of lean expenses, capital cities made choice investments in quality programming to drive more advertising revenue. They realized that the number one station and local news often ended with a disproportionate share of local ad revenue, and so they invested heavily in news talent and technology to lead local markets. Most of the media properties in capital cities were local leaders. As an example of a capital city's transformation, newspaper Kansas City Star was purchased in 1977 for $95 million, with $12.5 million in cash flow and single-digit margins. In 1996, cash flow grew to $68 million and margins grew to 35%. The Outsiders, 8 Unconventional CEOs. Chapter 2, Henry Singleton and Teledyne. Teledyne is an industrial conglomerate founded in 1960, currently involved in businesses ranging from aerospace electronics to digital imaging. Founder Henry Singleton served as CEO from 1960 to 1986, taking it through 3 phases with very different activities. 1. Rapid expansion of the conglomerate through acquisitions. 2. Aggressively buying back shares with the company's free cash flow. 3. Spinning out its subsidiaries when performance began stagnating. New section, Performance. From 1963 to 1990, Teledyne showed a 20.4% annual return rate, compared to 11.6% for the S&P 500 and 11.6% for major conglomerates. $1 invested at the beginning would have been worth $181 by 1990. This outperformed the S&P by 12 times and his peers by nearly 9 times. New section, History. Henry Singleton was born in 1916. He attended MIT for college and received a Ph.D. in electrical engineering. He won first place in the Putnam math competition and was nearly a chess grandmaster, clearly a smart guy. After graduating, he became a research engineer at a series of aviation companies. At Litton Industries, he led a business group that grew to $80 million in revenue and became the company's largest division. In 1960, at age 43, he left Litton to co-found Teledyne with a colleague. They began by acquiring 3 electronics companies and using this platform to win a large naval contract. Within a year, they became a public company. In this era of conglomerates, companies expanded quickly through acquisitions. Since private equity didn't yet exist, there was less competition for acquisitions, and acquired companies often traded for lower PE multiples than their buyers had in public markets. As a result, conglomerates had a virtuous cycle for acquisitions. Buying cheap companies raised short-term profits, which increased stock prices, which in turn was used to buy more companies. Singleton took advantage of these dynamics. In 8 years ending in 1969, he purchased 130 companies in a wide range of industries, including specialty metals and insurance. Most companies were purchased using Teledyne stock. In 1967, Singleton acquired Vasco Metals and promoted its president, and Singleton's former roommate at the Naval Academy, George Roberts, to president of Teledyne. As with Burke at Capital Cities, Roberts became the operating manager of Teledyne, freeing up Singleton to focus on strategy and capital allocation. In 1969, Teledyne's stock began falling in PE ratio, and acquisition prices began rising. Realizing that Teledyne's stock would no longer be profitable for acquisitions, he laid off his acquisition team and never made another material acquisition. Instead, they turned their focus to increasing margins at business units. Through the 1970s and 1980s, Teledyne saw remarkably high return on assets of 20% or greater. This generated remarkable free cash flow, which was used by Singleton in a series of aggressive share repurchases. At the time, the conventional wisdom held that repurchases were done only by weak companies that lacked investment opportunities. But given Teledyne's low PE ratio and high acquisition prices, Singleton reasoned that the best use of cash was to repurchase shares. Over 12 years, he bought back a staggering 90% of Teledyne's shares, becoming a pioneer in share repurchases as a financial strategy. As a result of share repurchases, from 1971 to 1984, Teledyne's earnings per share grew by 40-fold. From 1984, Singleton began planning for his succession. He promoted Roberts to CEO in 1986. By this time, Teledyne had begun showing stagnating results. Singleton's approach here, as usual, was unconventional. He began unpacking the Teledyne conglomerate, spinning off companies to be independent. For example, in 1990, he spun off Unitrin, Teledyne's largest insurance business, and the majority of Teledyne's company value. He believed disassembling the conglomerate would reduce Teledyne's complexity, thus reducing succession issues, as well as unlock more value for shareholders. Finally, in 1987, Singleton paid Teledyne's first dividend in its 26 years as a public company. The reasoning: stock prices and acquisition prices were at historic highs, while Teledyne's non-insurance companies were in a slump, and so he reasoned distributing cash flow to shareholders was the best use of money. Singleton retired in 1991, having realized a 20% compounded annual growth rate over the 30 years as a public company. New section, Management Practices. Acquisition Strategy. Singleton chose his acquired companies deliberately. Like Murphy at Capital Cities, Singleton had a financial benchmark for acquisitions, never paying more than 12 times earnings, and often paying single-digit multiples. In comparison, Teledyne's stock price ranged from 20 to 50 times earnings, thus making many acquisitions a great deal. Singleton also chose to focus on companies that were profitable, growing, and in leading market positions. They were often in niche markets. He avoided acquiring struggling turnaround companies, a common target of other conglomerates at the time. Share repurchases. Singleton's share buybacks were in a class of its own in its level of aggression. Over 12 years, he bought back a staggering 90% of Teledyne's shares, at one point buying over 20% in a single tender offer. He acted deliberately at opportune times. When Teledyne's stock price was low, when interest rates were low, he would use debt to buy back stock. Decentralization. In the era of conglomerates, the idea among many companies was that central headquarters could find large synergies among its subsidiaries. Thus, they employed armies of executives to conduct planning and strategy. In contrast, Teledyne's headquarters had fewer than 50 people, while its company employed over 40,000. They even had a small board, featuring just 6 directors, including Singleton. Focus on margins. Internally, the key metric was the Teledyne return, an average of cash flow and net income. For each business unit, this metric determined the general manager's bonus compensation. Focusing on this internal metric helped Teledyne achieve best-in-class profitability and cash flow, which fueled their growth. The Outsiders, 8 Unconventional CEOs Chapter 3, Bill Anders and General Dynamics. General Dynamics is an aerospace and defense corporation. After the end of the Cold War, it and many other defense companies faced a large contraction of spending as U.S. national defense priorities shifted. Incoming CEO Bill Anders successfully led a turnaround that made General Dynamics the industry's profit leader, instilling fundamentals that continue to this day. New section, Performance. From 1991 to 2008, General Dynamics showed a 23.3% annual return rate, compared to 8.9% for the S&P 500 and 17.6% for major conglomerates. $1 invested at the beginning would have been worth $30 by 2008. This outperformed the S&P by 6.7 times, and its peers by 1.8 times. New section, History. In 1989, the Berlin Wall fell, and with it fell the U.S. defense industry's business model. Accustomed to selling large weapons systems such as missiles and bombers, the defense industry now found its wares obsolete amidst new national priorities. Within 6 months, the price of leading defense companies had fallen 40%. General Dynamics was one of the worst affected companies. In 1991, it had $10 billion of revenue, but negative cash flow, as well as $600 million of debt, and thus had a market capitalization of just $1 billion. That year, Bill Anders joined as CEO. Bill Anders, 1991 to 1994. Anders was an Air Force fighter pilot and astronaut who held the rank of Major General at NASA, and was well respected at the Pentagon. At 45, he left government for the private sector, first for General Electric, and then for conglomerate Textron. An independent thinker and blunt communicator, he was a misfit for bureaucratic cultures. In 1989, he was made an offer to join General Dynamics, first as vice chairman for 1 year, and then to rise to CEO. He spent the year studying the industry with fresh eyes, where he came upon his strategic insight. During the Cold War, defense companies had become bloated with excess capacity. Now that much of their wares weren't needed, defense companies had 2 options: 1, shrink down dramatically to retain margins, or 2, acquire businesses to grow. In turn, his strategy for General Dynamics had 3 key ideas. 1, the company would only stay in businesses where it could be number 1 and number 2, a famous Jack Welch idea. 2, the company would leave commodity businesses with low returns. 3, the company would stick to its strengths. Namely, it would leave commercial businesses and stick to defense and government contracts. In his 3 years as CEO, Anders implemented a rigorous focus on margins and generating more cash. He found that the mindset of the company was to make bigger, faster weapons to grow revenue, with little care for shareholders and financial performance. He moved to instill a new mindset of financial performance, emphasizing cash return on capital. He made large personnel adjustments. He replaced 21 of the top 25 executives, reduced headcount by 60%, and cut corporate staff by 80%. He promoted Jim Mellor, a business unit head known for enforcing results, to COO. He and Mellor tightened operations by reducing inventory and capital equipment. They found a systemic problem of excess inventory, for instance, having dozens of F-16 plane canopies in a facility that made just one plane a week, as well as duplicate machinery. These moves produced fantastic returns: $2.5 billion in cash, and a market-leading return on assets. The other major move Anders employed was selling non-core businesses to other defense companies. He found that competitors were willing to pay premium prices to grow their businesses. Within 2 years, Anders sold the majority of their business lines, including their F-16 fighter plane division, to Lockheed for $1.5 billion. This was unprecedented in the defense industry. Observers say Anders was only able to do this because of his credibility in Washington as a military veteran. These sales generated another $2.5 billion in cash. What to do with this extra $5 billion in cash? Anders made 2 moves. 1. He paid special dividends to shareholders worth about half of the company's market capitalization. Even better, because they came from the sale of business units, they were deemed return of capital and weren't taxed as capital gains or ordinary income. 2. He used $1 billion to repurchase 30% of company shares. All of these moves, the generation of billions in cash, and its return to shareholders, made the stock price of General Dynamics shoot up. After serving as 3 years as CEO, Anders handed the reins to his COO, Jim Mellor. Jim Mellor, 1994 to 1997. Mellor continued discipline around operational excellence and selling the last non-core business units. However, in 1995 he made an uncharacteristic move by buying a Navy shipbuilder for $400 million. After years of the company shrinking, he had kicked off a new era for General Dynamics, one of growth. After 3 years as CEO, Mellor handed the reins to the company's general counsel and a key facilitator of Anders's strategy, Nick Shabraja. Nick Shabraja, 1997 to 2008. Shabraja set a lofty goal for himself as CEO: grow the stock price by 4-fold in 10 years, a 15% annual return. He figured the majority of this could come through market growth and improved operations. The rest had to come through acquisitions. While this departed from Anders's actions, the fundamental beliefs were the same. General Dynamics should grow only in core businesses it knew well. Shabraja began with small acquisitions, adding on to its information technology, tank production, and marine divisions. In 1999, he made his hallmark move, the $5 billion purchase of Gulfstream, the largest commercial jet manufacturer. The acquisition was equal to 56% of the enterprise value of General Dynamics. Observers criticized the move as departing from Anders's 3-point strategy from 1991, but Shabraja had a deeper logic. Gulfstream had stagnated in product development. In contrast, General Dynamics had considerable experience in aircraft from its previous days, and this expertise could be used to grow Gulfstream. In turn, Gulfstream would help diversify General Dynamics away from the fluctuations in military defense spending. In an unusual move for outsider CEOs, Shabraja sold stock to fund the purchase of Gulfstream. However, his logic was that General Dynamics was trading at all-time highs, 23 times projected earnings, versus the recent average of 16. He could sell 1/3 of the company to buy a business that would contribute half of its cash flow, a clear profitable arbitrage. When Shabraja retired from CEO in 2008, he had more than achieved his goal of quadrupling their stock price. Importantly, the 3 CEOs left a legacy of fundamental ideals. General Dynamics leads in all its business lines, and it has the industry's highest return on assets and margins. New section: Management Practices. Shareholder value as top priority. Many CEOs let ego drive their strategy, growing revenue and headcount with little concern for profits. It takes an egoless CEO to actively shrink the company for the sake of shareholder value. In a time when defense companies were scrambling to acquire other businesses to grow, Anders actively shed the majority of the business units at General Dynamics. These were not easy decisions. A former pilot, he had a special soft spot for the F-16 fighter jet division. But when Lockheed made an offer for the right price, he did it without hesitation. Flexible strategy. Outsider CEOs tended to avoid concrete strategic plans, instead preferring flexibility to adjust to the circumstances. When Anders was actively selling businesses, he had actually intended to grow the fighter jet business through acquisition. He approached Lockheed's CEO with the intent to buy their business, and was surprised when Lockheed instead countered with a generous offer to buy General Dynamics' F-16 business. Had Anders been more stubborn about retaining the business, he might have missed this opportunity. Likewise, a company needs different strategies in different situations. Anders grew the company's value by aggressively shedding its non-core businesses and shrinking the company through improved operations. Just 6 years later, Shabraja grew the business lines through thoughtful acquisitions, including the massive bet on Gulfstream. Even more notably, he did so by selling stock, a rare move among outsider CEOs, but appropriate at the time given that their stock was at an all-time high. Decentralization. Companies in the defense industry are often run by military veterans, so it's no surprise that they tend to be hierarchical, centralized, and run from the top down, just like the military. However, Anders and his two successors pushed continuously for decentralization. They shrunk headquarters and middle management by over 75% and shifted responsibility downward to the business units. There was active dissuasion of headquarters meddling with operating divisions. As is typical in outsider CEO companies, if the division chiefs hit their budgets, they were left alone. As part of its decentralization strategy, General Dynamics instituted bonus compensation based on long-term improvements in stock price. This was key to attracting capable talent to the company. The Outsiders, 8 Unconventional CEOs. Chapter 4, John Malone and TCI. Telecommunications Incorporated, TCI, was a cable television provider founded in 1958. It grew to be the largest cable company in the country, owning both cable providers and content programming. It was acquired by AT&T in 1999 for $43.5 billion in stock and, through a series of transactions, would ultimately become Comcast. As CEO from 1972 to 1991, John Malone pursued a virtuous cycle strategy: grow subscriber count through acquisitions of cable providers, which would give scale to negotiate lower fees with content providers, which would make acquisitions of cable companies further cheaper. New section, Performance. From 1973 to 1998, Teledyne showed a 30.3% annual return rate, compared to 14.3% for the S&P 500 and 20.4% for public cable companies. $1 invested at the beginning would have been worth $900 by 1998. This outperformed the S&P by 40 times and his peers by 5 times. New section, History. John Malone was born in 1941 and earned bachelor's degrees from Yale in economics and electrical engineering, as well as graduate degrees in operations research from Johns Hopkins. He worked at Bell Labs, studying financial strategies in monopoly markets. Unhappy with the bureaucratic culture at AT&T, he joined McKinsey as a consultant. While at McKinsey, he studied the cable industry, and he immediately saw an attractive opportunity. The cable industry had stable subscriber bases, which led to predictable revenue, and thus accurate forecasting and strategic planning. The nature of the business allowed tax maneuvers to reduce taxes on cash flow. Essentially, they could use debt to build new cable systems and depreciate the costs. The depreciation charges and interest expenses were both tax-deductible, which would decrease net income and thus taxes. A cable company with healthy cash flow could thus pay little in taxes. Furthermore, it could repeat this cycle indefinitely, continuously taking on debt to acquire more cable systems. The cable industry was growing extremely quickly, with subscribers growing 20-fold over a matter of years in the late 1960s and early 1970s. In 1970, one of his clients at McKinsey, General Instrument, made an offer to him to run Gerald, its cable television equipment division. Within 2 years, he was made an offer by TCI to join as CEO. TCI was founded in 1956 by Bob Magnus and had gone public in 1970. In 1973, when Malone joined, it had 600,000 subscribers and was the number 4 cable company in the U.S. It had taken on a troubling amount of debt, 17 times revenue, and was dangerously close to bankruptcy. 1973 to 1977, stabilization. Malone's first priority was to keep TCI out of bankruptcy. He instituted a new lean culture focused on financial discipline, estimating that growing subscribers by 10% per year while maintaining margins would keep them out of bankruptcy. He maintained frugality at headquarters, keeping just a single receptionist and grouping multiple executives in the same motel room when traveling. Characteristic of outsider CEOs, Malone had a COO, J.C. Sparkman, who enforced budgeting and cash flow benchmarks at the operating divisions. Managers who underperformed were fired. Over his first 4 years, Malone pushed TCI to produce the highest margins in the cable industry and saw consistent subscriber growth and cash flow. 1977 to 1990, growth. Once TCI stabilized, Malone could pursue his master strategy, a virtuous cycle of growth. At cable companies, the largest expense, 40% of operating expenses, was paid to content suppliers, called programmers, like HBO and MTV. Larger cable providers were able to negotiate lower fees per subscriber. Malone realized that the key was to increase size, which would allow for increasingly better business economics, which would in turn allow for increased size. Here's how the virtuous cycle worked in more detail. Buying more cable systems would lead to more subscribers. This would lead to lower programming fees per subscriber, which would increase cash flow. Higher cash flow allowed the company to take on more debt, which could be used to buy more cable systems. This would further improve programming fees and so forth. In essence, larger cable companies could pay more for acquisitions than smaller competitors, since they could extract more value from them. Malone executed the strategy relentlessly, acquiring 482 companies from 1973 to 1989. This was a rate of 1 every 2 weeks. His sole focus was on acquiring subscribers at good prices. Maintaining financial discipline, Malone avoided the costly competitions for urban markets, instead focusing on rural and suburban areas. He felt other cable companies were bidding up the price of urban markets, thus making them unprofitable. Indeed, when years later the urban companies failed under too much debt and low profits, Malone acquired them at much lower prices, leading to better economics. In 1982, TCI became the largest cable provider, with 2.5 million subscribers. Joint ventures. In addition to growing subscribers, Malone was interested in partnering with cable programmers. He took minority stakes in new programming businesses, in exchange for capital and access to TCI's subscriber scale. Thus Malone built partnerships with rising channels such as BET, Discovery, and QVC. He was unique among cable companies for doing so at the time. These investments would be a large part of TCI's ultimate value. 1990s, spin-offs and sale. Through the 1990s, a shifting environment put a damper on the cable industry. New regulation limited cable rates and access to debt for cable companies, which stifled growth. Furthermore, the cable industry faced increasing competition from satellite television. Realizing that better opportunities might lay outside cable, Malone shifted his focus. He helped create 2 new businesses, Teleport, a telephone service, and Sprint/PCS, a partnership with Sprint for cellular service. These would later generate significant value. Teleport was sold to AT&T for $11 billion, a 28x return on investment, and Sprint/PCS was sold to Sprint Corporation for $9 billion. He spun off 14 non-core businesses. For instance, minority investments in programming were packaged as Liberty Media. He believed this would increase transparency into the operating divisions of TCI and reduce regulatory antitrust attention. He contracted General Instrument to produce 10 million set-top boxes that would enable competition with satellite TV, in exchange for 16% equity in the company. Motorola later acquired General Instrument for $11 billion in 1999. As the 1990s wore on, Malone became increasingly concerned about TCI's future. In addition to the regulation and competition from satellite television, TCI's rural cable networks were also wearing down and would need to be upgraded at significant expense. He also didn't have a clear successor. His COO Sparkman retired in 1995. In 1998, he found a buyer in AT&T and negotiated a striking deal, $43.5 billion in stock, which was 12 times EBITDA and $2,600 per subscriber. In addition, he negotiated a long-term deal for Liberty Media's programming on AT&T Cable. New section: Management Practices. Intelligent use of debt. Like many acquisitive outsider CEOs, Malone used debt to finance acquisitions. As described earlier, he saw that growth for cable companies could come more cheaply than expected. Depreciation of capital expenditures and interest expenses would reduce taxes, even if the company had healthy cash flow. Furthermore, increasing scale allowed TCI to access cheaper debt. Through much of his tenure, he maintained a ratio of 5x debt to EBITDA. Malone also structured the debt intelligently to prevent defaults in one loan from cascading and causing systemic problems. In technical terms, he avoided cross-collateralization. Short-form note: Enron's downfall was caused in large part because of complicated dependencies between their loans. Read our summary of the smartest guys in the room to learn more. Acquisition strategy. As described earlier, Malone engaged in acquisitions to fuel the virtuous cycle of subscriber growth, leading to better economic terms with content programmers, leading to further subscriber growth. Like many outsider CEOs, Malone wasn't haphazard about acquisitions. He had a clear rule: pay a maximum of 5 times cash flow, after all the fee discounts and operational efficiencies were realized. This simple rule let him move quickly when the price was right, and let him walk away quickly when it exceeded his maximum price. After the acquisition, like Tom Murphy in Capital Cities, Malone and Sparkman would institute a lean environment and cut all unnecessary expenses. For example, for one cable franchise, TCI cut payroll in half and moved the team from a downtown skyscraper office to a tire warehouse. Unconventional financial analysis. Malone believed that the conventional measure of company performance, earnings per share, was a foolish yardstick for the growing cable industry. He saw that higher earnings meant paying more taxes, which would bleed money that could be used to scale a cable company. Therefore, he ignored EPS, instead focusing on cash flow. In fact, Malone pioneered the use of EBITDA, earnings before interest, taxes, depreciation, and amortization. At the time, EBITDA was a radically new reflection of a company's cash flow. Today, it's universal in financial analysis. Limited capital expenditures. As a capital allocator, Malone only invested in projects that provided clear and compelling returns. One project that often did not meet this bar was improving cable infrastructure. Capital expenditures would reduce cash flow, and he did not see the return on investment on upgrading to new technology. Knowing that implementing new media technology was costly and difficult, he preferred to wait for his competitors to scramble over each other and pave the way first. Then he learned from their mistakes and pursued only the paths proven to be economically viable. He was not shy about one area of investment: joint ventures. At the time of sale, he had developed 41 partnership interests, many in programmers. Among his competitors, he was unique in recognizing the value of investing in cable entrepreneurs and having a mutually beneficial relationship by providing scale to the burgeoning programmers. Stock buybacks. Like other outsider CEOs, Malone repurchased a large portion of shares, over 40% of outstanding shares. He took advantage when TCI stock reached especially low multiples. When allocating capital, he would compare the value of buying back stock to making more acquisitions, then make the more profitable transaction. The Outsiders, 8 Unconventional CEOs. Chapter 5, Katharine Graham and the Washington Post. The Washington Post was owned by Eugene Meyer, whose daughter was Katharine Graham. Her husband, Philip Graham, was hired by Meyer to lead the Washington Post from 1946 to 1963. However, Philip committed suicide in 1963, and Katharine was expected to take over management. An inexperienced executive, Catherine hadn't worked for 20 years when she took the CEO role. But through wise decisions around both editorial and business, the help of strong executives, and a key advisor by the name of Warren Buffett, she led the Post to be the most successful newspaper company of its class. News section, performance. From 1971 to 1993, the Washington Post Company showed a 22.3% annual return rate, compared to 7.4% for the S&P 500 and 12.4% for public newspapers. $1 invested at the beginning would have been worth $89 by the end. This outperformed the S&P by 18 times and her peers by 6 times. News section, history. In 1963, Katharine Graham became CEO of the Washington Post. At the time, the Post had grown to include Newsweek magazine and 3 TV stations. She spent a few years learning the ropes. In 1967, she made an unconventional staffing choice. She replaced her veteran editor-in-chief with a young firebrand, Ben Bradlee. Changing from a veteran to a newcomer was an odd choice, but Graham believed she needed someone with a better grasp of the 1960s zeitgeist. Bradlee's energy would prove vital in raising the profile of the Post's newsroom in its stories. In 1971 and 1972, the Post clashed with the Nixon administration over stories critical of the presidency. This included the breakthrough investigation of the Watergate scandal. Despite the Nixon administration's threats to impede the Post with regulatory scrutiny, Graham pushed forward and published the stories. These elevated the stature of the Washington Post, putting it on equal footing with the New York Times. In 1971, Graham took the Washington Post Company public to raise money for acquisitions. She started by buying the Trenton Times, which was a number 2 paper in a competitive market and showed mediocre performance. This would teach her discipline in acquisitions going forward. In 1974, a relative unknown began buying stock in the Post, ending with 13% ownership. His name was Warren Buffett. While her board counseled her to avoid the unknown, she met with him and found his advice indispensable, and she invited him to join the board. He would prove to be vital throughout Graham's tenure, advising her around capital allocations. In 1975, the Post faced a workers' strike from the paper printers. Determined not to give in, Graham hastily hired a crew to man newspapers, publishing for 139 days before the printers conceded. Winning many favorable concessions, Graham made big improvements to the Post's margins. Around this time, Buffett advised Graham to repurchase Post shares, given their low prices. She repurchased 40% of Post shares, an unusual move that her competitors didn't follow. In 1981, the other major newspaper in Washington, the Washington Star, shut down. The Post became a monopoly daily newspaper in Washington, D.C., which greatly increased its circulation and profitability. Also in 1981, Graham hired a strong COO, Dick Simmons. Like other COOs for the outsider CEOs in this book, Simmons carried operational excellence to the Post's business units, increasing margins, improving compensation structure. During the 1980s, the newspaper industry went on an acquisition spree, bidding up prices aggressively. Graham didn't participate, finding the assets overpriced. Instead, they looked to businesses outside media, acquiring companies in telephone, test preparation, Kaplan, and cable television from capital cities. Each of these would both rise in value and provide a valuable counterweight to the newspaper business as it declined due to the internet. As the early 1990s approached with a recession, the Post became acquisitive while its competitors sat back, oversaddled with debt. Graham purchased companies at significant discounts in cable television, TV, and education. Graham stepped down in 1993, leaving a legacy of strong performance and excellent financial returns. News section, Management Practices. Financial Allocation. As with the other outsider CEOs, Graham's choices around how to get money and how to spend it caused the Post's outperformance. The Post's main source of capital was cash flow, generated when the Post lost its main competition in Washington, and when her COO Simmons made business units more efficient. Unlike other CEOs mentioned thus far, Graham rarely sold Post businesses and did not regularly use debt. She rarely paid dividends, a rarity among newspaper companies, which were owned by families who depended on dividend income. She minimized capital expenditures, resisting upgrading print facilities. Like Malone at TCI, she preferred to let competitors rust into costly new technologies, waiting for them to prove economically profitable and allowing time to drive costs down. She avoided acquisitions when everyone else was acquiring, and she acquired companies when no one else was. Her trading rule: acquisitions had to return 11% over a 10-year period without leverage. She repurchased almost 40% of stock at opportune times, usually at single-digit PE multiples. The Outsiders, 8 Unconventional CEOs. Chapter 6, Bill Stiritz and Ralston Purina. Ralston Purina was a consumer packaged goods company producing commercial animal feed, consumer pet food, and human foods. When Stiritz joined as CEO in 1981, Ralston had a muddled focus, having purchased a hockey team and ski resort, and a stagnant stock price. Stiritz revitalized the company with discipline, divesting unprofitable business units and acquiring new genuinely synergistic businesses. In 2001, Ralston merged with Nestlé in a transaction worth $10.4 billion. New section: Performance. From 1981 to 2001, Ralston showed a 20% annual return rate, compared to 14.7% for the S&P 500 and 17.7% for peer companies. $1 invested at the beginning would have been worth $38 by 2001. This outperformed the S&P by 2.5 times and his peers by 50%. New section: History. In the 20th century, consumer packaged goods companies like Heinz and Kellogg largely moved together as a pack. They were considered stable blue-chip stocks, paying out dividends and resisting recessions. During the 1960s and 1970s, they acquired aggressively in pursuit of synergy and vertical integration, ending up in industries like restaurants and agriculture. Ralston Purina had done the same. With its core in agricultural feed, it had ended up with broad interests in a fast food chain, Jack in the Box, crop farms, a hockey team, the St. Louis Blues, and a ski resort. In 1980, when CEO Hal Dean stepped down, its stock price was the same as a decade prior. During the board's search for CEO, an internal executive, Bill Stiritz, submitted an unsolicited plan for revitalizing the company, sell businesses that were performing poorly, and reorganize the company around its high-margin consumer brands. The board director read the plan and knew it was the right direction. Stiritz got the job. Stiritz had spent his early career at Pillsbury as a field rep and at an advertising agency. This would provide on-the-ground experience in both distribution and marketing. In 1964, at 30 years old, he joined Ralston Purina in the consumer products division, pet foods and cereals, considered one of the weakest divisions of the company. He introduced still-famous brands Purina Puppy and Cat Chow, and, during his time in the division, its profits increased 50-fold. Unlike other outsider CEOs, Stiritz had been an insider at the company for over a decade. But he brought an unconventional plan that deviated from competitors. He knew that the consumer brands had attractive economics, high margins, low capital requirements, and focusing on this core would propel Ralston to new heights of profitability. When he became CEO in 1981, he implemented his plan decisively. First, he sold the non-core businesses such as Jack in the Box, the hockey team, and the agricultural operations. Then he made 2 large acquisitions: Continental Baking, including Twinkies and Wonder Bread, and Energizer Battery, totaling over $2.2 billion and 30% of Ralston's market capitalization. Both businesses had languished under their previous owners, due to neglect or insufficient skill set. Ralston quickly improved its performance by improving marketing, launching the Energizer Bunny campaign, improving distribution, launching new product lines, and reducing costs. Over their lifetime at the company, Energizer would generate 21% annualized returns, and Continental 13%. Over the 1980s, he continued executing the plan, adding acquisitions that would strengthen the consumer brand core while divesting businesses that could not generate sufficient returns. The company's financial metrics improved considerably. Return on equity increased from 15% to 37%, and pre-tax profit margins increased from 9% to 15%. In the 1990s, he continued focusing the company. He spun off smaller brands like Chex cereals into a new company, Ralcor, and he sold the last of the agricultural operations to DuPont. His last two moves were defining moments. In 2000, he spun off Energizer Holdings, which then represented 15% of Ralston's enterprise value. This left Ralston with a sole focus on pet food. In 2001, he negotiated a sale of Ralston to Nestlé for $10.4 billion, or 14 times cash flow. With this done, Stiritz had turned around a stagnating company, made it the dominant player in consumer goods, and returned considerable value to shareholders. New section, Management Practices. Analytical Approach. Stiritz took a quantitative approach to management. A poker player in his youth, he saw capital allocation like poker: read the table, calculate odds, and know when to bet big when you're likely to win. He would use his quantitative approach in capital allocation, such as deciding between repurchasing shares and conducting an acquisition, based on return on investment. He saw analysis as critical to independent thinking, particularly in the CEO position. He felt that CEOs who lacked an analytical mindset, for instance, if they came from areas like marketing or legal, were handicapped in their role. Focus on core. Stiritz's first focus was on improving the high-margin, low-capital requirement consumer businesses. He exited businesses that were once critical, but had become commoditized, such as agricultural feed, while reinvesting in its key consumer brands. This generated cash flow to use to raise debt, buy back stock, and make acquisitions. Use of debt. Stiritz was fond of using leverage to achieve higher returns on equity. This followed the leveraged buyout practices of private equity firms, but it was an unorthodox move for packaged goods companies, which preferred having conservative balance sheets. Over his tenure, he kept an average debt-to-cash flow ratio of 2.6, compared to 1.7 for his competitors. Share repurchases. Buying back shares was controversial in the 1980s, since it meant shrinking the company or admitting that there were no worthwhile investments to make. Instead, Stiritz used buybacks as a yardstick for return on investment. If an acquisition or internal investment could beat the return on buying back shares, it was worth doing. As with other outsider CEOs, most shares were purchased when company stock was at low PE ratios. Acquisition strategy. Stiritz focused on companies that could be reinvigorated by Ralston's expertise in marketing, product development, and distribution. He liked companies that had been neglected by their previous owners, such as Continental Baking and Energizer. When purchasing companies, Stiritz preferred to negotiate through direct contact, not with investment bankers, whom he considered parasitic. He would often show up alone to meetings where the opposition was staffed with a row of advisors. Unconventional financial analysis. Like Malone at TCI, Stiritz rejected the conventional metrics of the day, such as reported earnings and book value. Instead, he focused on more meaningful metrics like EBITDA and internal rate of return, both of which had gained early acceptance among private equity investors. The Outsiders, 8 Unconventional CEOs. Chapter 7, Dick Smith and General Cinema. General Cinema was a movie theater company founded in 1922 by Philip Smith, who expanded drive-in theaters throughout New England and the Midwest. When he died in 1962, his son Dick Smith took over as CEO. Dick further expanded the company's theater locations, then diversified into unrelated businesses such as beverage bottling and retail. While diversifying acquisitions often end in failure, Smith executed them with finesse, leading to fantastic performance when the company's divisions were sold at premium prices in the 2000s. New section, Performance. From 1962 to 2005, General Cinema, and its spin-offs, showed a 16.1% annual return rate, compared to 9% for the S&P 500 and 9.8% for GE. $1 invested at the beginning would have been worth $684 by the end. This outperformed the S&P by 15.8 times and GE by 11.4 times. New section, History. In 1962, when Dick Smith was 37 years old, he took over as CEO of General Cinema. He had been working in the family business after graduating from college and World War II. Movie theaters had strong economics. It had negative working capital, since moviegoers paid instantly, but movie studios were paid on 90-day terms. It had low capital requirements. A theater took little to maintain once it was built. Smith's first move was to expand the company's theater footprint. He innovated in 3 ways. He expanded into suburban shopping malls, realizing that demographic trends were pointing to population growth in these areas. He expanded quickly by leasing land to develop theaters on, instead of purchasing the land under it. He realized that the theater's strong, predictable cash flow would make this financially viable, and it reduced the upfront investment needed for new locations. He increased the number of screens per theater to increase audiences and concession sales. Diversification into beverages. By the late 1960s, he figured that theater growth would likely plateau at some point, so he began looking to diversify into other businesses. His ultimate goal was to have 3 legs in the company, each a strong business that wasn't correlated with the others. In 1968, he entered beverage bottling by purchasing American Beverage Company, ABC, the largest independent Pepsi bottler, for 20% of his company's enterprise value. His work in theater concessions had given him an appreciation for the attractive market dynamics of beverage bottling. Beverage companies formed an oligopoly, representing high returns on capital and strong long-term prospects. Pepsi bottlers tended to be fragmented, compared to the larger Coca-Cola bottlers. Furthermore, since they served the number 2 brand, Pepsi, they tended to have lower valuations. Thus, Smith could buy up bottlers for lower prices. ABC could serve as a platform company to which new acquisitions of bottlers would be added to increase scale and profits. Over the next decade, Smith purchased more bottling companies. Increasing scale allowed for ever more efficient operations, such as negotiating down can prices and buying its own sugar instead of having it supplied by Pepsi. The third leg: retail. With this business established, Smith searched for his third leg. He explored broadcast media, though the prices were so high he never made a meaningful entry. He engaged in making minority investments in public companies. His opportunity came in 1985, when he was called in to help retail conglomerate Carter Hawley Hale, CHH, avoid a hostile takeover. CHH owned properties such as department stores Broadway and Neiman Marcus. CHH desperately needed an investor to buy a substantial portion of shares to defeat the takeover, and they needed a response within a literal few days. Smith realized that the seller's urgency and tight timetable meant that very few buyers would participate, and so he could have immense negotiating leverage. Over the weekend, he and his team scrutinized the deal, prepared financing, and closed the deal by Thursday. Flexing his leverage, Smith secured very favorable terms. A preferred security guaranteed them a 10% return, gave them an option to convert to 40% of common stock, and options to buy operating divisions of CHH. In essence, they borrowed money at 6% to earn 10%. Later, General Cinema exchanged its 40% stock in CHH for 60% of the retail division that included Neiman Marcus. Smith saw that Neiman Marcus was poorly managed by its owner, and growth of stores would allow a premium on exit. Altogether, this investment in CHH would ultimately return at a rate of 51.2%. Good work for a weekend. Sale and a new third leg. In the late 1980s, the Pepsi beverage industry soured due to aggression from Coke and increased competition for buying beverage franchises. He sold the bottling business to Pepsi and started looking for another third leg. In 1990, the publisher Harcourt Brace Jovanovich, HBJ, piqued his attention. HBJ published in Education and Science. In 1986, it faced the threat of a hostile takeover, and so it took on a large amount of debt and paid a large dividend. HBJ avoided a takeover, but it now staggered under its debt. It began missing debt payments, and vulture investors circled, waiting for a kill. HBJ decided to go up for auction. As with CHH, Smith knew that he had leverage in this acquisition. HBJ's complicated debt required a complicated deal, which would scare off buyers. However, publishing had low capital requirements and few assets, thus improving its economics. Over 18 months, Smith negotiated with its creditors and ultimately purchased the company for $1.56 billion, over 60% of General Cinema's market capitalization. He got it at a discount of 6 times cash flow. The end. Over the 1990s and 2000s, Smith gradually sold the operating businesses. In 1991, the theater business was spun off into GC companies, which would ultimately go bankrupt in 2000 and be purchased by AMC. In 2003, HBJ was acquired by Reed Elsevier. In 2006, Neiman Marcus was acquired by a group of private equity firms. Smith saw that expanding Neiman Marcus would be expensive, while private equity firms were paying record amounts for retail. With this, General Cinema ceased to operate, returning tremendous value for shareholders through 43 years of Dick Smith's leadership. New section, Management Practices. Opportunistic Acquisitions. Smith's acquisitions often featured special opportunities where he could exert leverage. For Pepsi beverage bottlers, Smith knew that the fragmentation of the industry and number 2 status of Pepsi meant better prices for buying each bottler. For the retailer CHH under threat from a hostile takeover, he knew the tight turnaround meant low competition, while he could uniquely move fast given his clear acquisition criteria. For HBJ, he knew that the complicated debt structure would turn away buyers. Strong operating team. Smith collaborated closely with 3 top executives, his CFO, COO, and legal counsel. They actively debated company strategy, and Smith invited them to publicly disagree with him, even in front of the board. As with other outsider CEOs, Smith left day-to-day operations to his 3 top executives, instead focusing on strategy and capital allocation. Capital allocations. In general, for capital allocations, Smith behaved like other outsider CEOs in these ways. He avoided issuing stock, holding onto shares like a feudal lord. He paid little in dividends. He repurchased a third of General Cinema shares over time, with an internal rate of return of 16%. He preferred to focus on cash earnings, not reported income. He used debt to fund acquisitions, with debt-to-cash flow of 3 times or more. He minimized taxes, enjoying a reduced rate of 33% compared to the nominal corporate tax rates of 50%. The Outsiders, 8 Unconventional CEOs Chapter 8, Warren Buffett and Berkshire Hathaway. Saving the best for last, the author ends with Warren Buffett's staggering returns over the 50-plus-year history of Berkshire Hathaway. Starting with buying a textile company in 1965, Buffett grew Berkshire Hathaway into one of the world's largest companies. Over the years, Buffett excelled in all manners of investments in both public and private companies, with ownership of both minority and total stakes. He famously made use of insurance float to fund investments in higher return companies, held a small basket of companies for very long periods of time, and acted aggressively when everyone else was ducking for fear. New section, Performance. From 1965 to 2011, Berkshire Hathaway showed a 20.7% annual return rate, compared to 9.3% for the S&P 500. $1 invested at the beginning would have been worth $6,265 by 2011. This outperformed the S&P by a staggering 100 times. New section, History. Born in 1930 in Omaha, Nebraska, Warren Buffett was the son of a stockbroker and the grandson of a grocery store owner. His early entrepreneurial activities included paper routes and reselling soft drinks. When he was 19, he read The Intelligent Investor by Benjamin Graham, which converted him into value investing, buying companies that were cheap relative to their intrinsic value, which was based on the company's balance sheet. He began investing the profits from his ventures, worth about $10,000 in today's dollars. When pursuing his MBA, he chose to go to Columbia, where Graham was a professor. After graduating, Buffett asked Graham for a job at his investment firm, but Graham declined. Buffett returned to Omaha to work as a stockbroker, where he continued researching investments. Here he happened on Geico, an insurance company that featured competitive advantages and a great value for the price. He invested most of his money in Geico. In 1954, Graham finally offered Buffett a job, and Buffett continued researching underpriced public companies, which were often cheap, low-quality companies. Buffett called them cigar butts. When Graham closed his firm in 1956 to focus on other interests, Buffett started his own fund in Omaha, raising $105,000, a bit under $1 million today. Over the next decade, Buffett continued investing by Graham's value philosophy, achieving an average 30% annual return even without using debt. Buffett refines his investing style. But in the mid-1960s, Buffett began deviating from the value method, instead investing in high-quality companies that had a strong competitive profile and long-term prospects. His early investments in this style included Disney and American Express. In 1965, Buffett purchased the textile company Berkshire Hathaway, a 100-year-old family business, through a hostile takeover. The company was only worth $18 million in enterprise value and was in a commodity business, but Buffett saw it as a platform to build his investments around. After installing a new CEO, who optimized operations, Berkshire Hathaway had $14 million of profit. Buffett used this profit to buy National Indemnity, an insurance company that generated a large amount of float, the value of premiums received before they are paid out as claims. Insurance companies rely on investment returns from float to generate a profit. Sometimes years can pass between when premiums are received and when they need to be paid out. In essence, Berkshire was able to receive cash at 3% and invest it at 13%. Buffett used this float to invest in businesses, sometimes buying them outright. His purchases included a newspaper in Omaha and a local bank in Illinois. His investing style was further honed in the 1970s as inflation was a common concern among investors. The typical thinking was that hard assets like gold were the best protection against inflation. Buffett saw differently and developed key components of his investment thesis. He believed that companies that had the ability to raise prices and that had low capital requirements were best protected against inflation. These companies included beloved consumer brands that were market leaders. The best way to value a company was based on income statement and cash flows, as well as intangibles like brand power and market share. This was a departure from Graham's method of using balance sheet and net working capital. To avoid leakage of growth to taxes, Buffett would prefer holding investments for a long time. This allowed for longer periods of compounding growth without paying taxes on exiting positions. In short, where Benjamin Graham might have considered a company too expensive based on its book value, Buffett saw it could be cheap, because of the company's long-term potential to consistently generate high returns on capital. One example is illustrative. In 1972, Buffett purchased See's Candies for $25 million, when it had $7 million in book value and $4.2 million in pre-tax profits. At 3 times book value, it would have been too expensive for Graham, but at 6 times pre-tax income and strong brand loyalty, it was a reasonable purchase. Over the decades, See's Candies has not grown unit sales tremendously, but its strong brand allowed it to raise prices consistently. See's earned a 32% annual return over 27 years, and has provided $1.65 billion in cash flow for reinvestment. Throughout the 1970s and 1980s, Buffett thus began investing in high-quality, enduring companies, such as the Washington Post, Geico, and General Foods. He both made minority investments and purchased companies outright, such as with See's Candies and the Nebraska Furniture Martinique. To today. Among its many investments in the decades since, Berkshire Hathaway is known for these highlights. In 1986, he made the firm's largest investment yet, $500 million, to help Tom Murphy, another outsider CEO, acquire ABC, ending up with 18% of the combined company. In 1989, he purchased a whopping 7% of Coca-Cola, with the stake being a quarter of Berkshire's book value. In the 1980s, Buffett invested in Salomon Brothers, Gillette, and U.S. Airways. In the 1990s, Buffett invested in Wells Fargo, General Dynamics, and American Express. In 1998, he purchased reinsurer General Re for $22 billion, the largest deal yet. Around the time of the September 11 attacks, he opportunistically purchased in industries the market had turned away from, such as with Benjamin Moore Paints and Shaw Carpets. In 2003 and 2004, Buffett invested outside equity markets, investing in junk bonds and currency, where he bet against the dollar. After a relatively quiet few years, he leapt into action during the 2008 financial recession. In the few years following the collapse of Lehman Brothers, he deployed over $80 billion, including $8 billion in convertible stock from Goldman Sachs and General Electric, $9.5 billion in mezzanine financing to Mars/Wrigley and Dow Chemical, $8.9 billion in distressed debt securities, $26.5 billion for the remaining 77.5% of Burlington Northern Santa Fe, the country's largest railroad network, that he didn't own $10.9 billion in IBM stock. Berkshire Hathaway continues to be one of the most highly valued enterprises in the world. Having avoided stock splits in its history, Berkshire shares are now worth hundreds of thousands of dollars each. New section: Management Practices. Insurance float. A big part of Berkshire's investment strategy is its use of low-cost insurance float to invest in higher return businesses. As a reminder, insurance float is money the company receives in premiums before they are paid out as claims. The time gap can be many years. In essence, this is like getting cash at 3% to reinvest at 13%. Over the years, Berkshire continued scaling up the strategy in an accelerating flywheel effect. He could use insurance float to purchase companies that generated cash flow, which in turn he could use to buy more insurance companies, which generated more float to purchase companies. Insurance float grew from $237 million in 1970 to $70 billion in 2011. As a large diversified company, Buffett also had more control over his insurance companies' underwriting to maximize profitability. When premium pricing was low, Buffett's insurance companies would underwrite fewer premiums. When pricing was high, it would take advantage by underwriting multiple-fold more in premiums. For instance, between 1984 to 1986, premiums grew sixfold, then shrank 73% by 1989. It'd be difficult for an independent public insurer to do the same, since its investors expect smooth performance. A wide range of investment options. Having had extensive experience in investing before starting Berkshire Hathaway, Buffett had a wider range of investment options than most CEOs. Typical CEOs only look within their immediate industry. In contrast, Buffett has made investments in a vast array of industries, from beverages to industrials. Even his investments take a wide range of flavors, including investments in both private and public companies, both minority investments and complete acquisitions, and at times making big bets in bonds and currencies. Opportunistic temperament. Buffett has said that as an investor, it's important to be fearful when others are greedy, and greedy when others are fearful. Buffett is content to be patient for years when companies are overvalued, and he doesn't see acceptable opportunities. Then, when other investors are in turmoil, as in the 2008 financial crisis, Buffett strikes aggressively. Beyond larger trends, Buffett enjoys finding opportunities within industries and individual companies. Pessimism within an industry can obscure strong performers within the industry. Buffett invested in Freddie Mac in 1989 during the recession, and in General Dynamics in 1992 during the defense industry slump. He also finds companies in the midst of a major strategic change, such as when a new CEO announces a focus on the company core and divestments of low-performing businesses. This also means being ruthless about not tolerating poor performance and low returns. When Buffett purchased Berkshire Hathaway in 1965, he chose never to enter textiles again, seeing it as a commodity business with poor long-term prospects. Instead, he merely harvested capital from Berkshire and invested it elsewhere. Choosing what not to do is often as important as choosing what to do. Portfolio management. Portfolio management concerns 1. How many stocks an investor owns, and 2. How long he holds them. Buffett believes that great companies are rare, and that concentrated portfolios generate great returns. Berkshire has advised students that if they were only limited to 20 total investments throughout their career, they would drastically improve their performance. As a result, Berkshire is famously concentrated among its holdings. The top 5 holdings typically make up 60 to 80% of Berkshire's value. At one time, Buffett had 40% invested in American Express. In contrast, mutual funds are often made up of hundreds of stocks, with no single stock making up more than a few percentage points. Buffett also holds stocks for a very long time. His top holdings have been held for over 20 years. This lack of transaction activity allows compound interest to continue generating massive returns without leakage through taxes. In contrast, mutual funds often hold for less than 1 year. Inversely, Buffett aims for Berkshire shareholders to be long-term partners as well. He has never split Berkshire shares, which currently trade at hundreds of thousands of dollars. Decentralization of operations. Despite Berkshire's companies employing 270,000 people, its headquarters has only 23 people. Warren Buffett is famously hands-off with his management of owned companies, believing this reduces overhead and encourages entrepreneurship. When he buys a company, he leaves the management team in place and rarely makes changes. Then Buffett doesn't expect the CEO to call him unless Buffett can help. There are no regular budget meetings. As long as the company performs, Buffett leaves them alone. This is a major part of Berkshire's appeal when sellers consider being acquired by Berkshire. Unlike a private equity buyer or larger company, Berkshire will allow management to continue running the business. This gives Berkshire an advantage in appealing to certain types of sellers. Centralization of investments. However, like most other outsider CEOs, Buffett is completely centralized in capital allocations. All capital flows to headquarters to allocate. Buffett personally takes charge of negotiations, and he does not rely on investment bankers or business development to make deals. Buffett also believes in having a relatively small board, and requiring all board directors to have a personal stake in decisions. This means 1. A meaningful investment of personal capital into the business. 2. No insurance. 3. Avoiding fees that represent a large percent of the director's income. This aligns board members much better with the performance of the business. In contrast, board members who have little ownership in the business, have insurance that protects them from downside, and are paid large fees are far less interested in guiding the company correctly. Acquisition style. Buffett is remarkably quick at making a purchase decision. He spends less time on due diligence and often makes deals within days. He never visits company locations and rarely meets management. He can move quickly because he only invests in industries he knows deeply, and he has honed his investment criteria. This lets him filter the key performance indicators of a business. Buffett also avoids auctions, believing they drive up valuation needlessly. He prefers that owners call him and offer a price, with Buffett returning his answer within 5 minutes. The Outsiders, 8 Unconventional CEOs Checklist for Outsiders. Here's a 10-step checklist for outsiders. 1. The CEO should lead capital allocation decisions, not delegate them to advisors or employees. 2. Determine the hurdle rate, the minimum return necessary to approve a project. The hurdle rate should generally exceed the cost of capital, usually in the mid-teens or higher. 3. For all investment options available, calculate returns and risk profiles. Higher risk projects should have higher returns to compensate. Keep it simple. Understand the key assumptions of the project that drive returns. Be conservative. Be cautious about calling a project strategic. It often means low return. 4. Make sure you calculate the return for stock buybacks. This should be the hurdle for all acquisitions. 5. Make sure you calculate after-tax returns, since different projects may have different tax properties. Consult tax counsel. 6. Determine acceptable cash and debt levels for the company. Do not stray outside these margins of safety. 7. Consider decentralizing your management. How can you reduce staff at corporate headquarters? 8. Retain earnings only if you have projects that clear your hurdle rate. Otherwise, consider a buyback or paying dividends, always being mindful of taxes. 9. If prices are high, consider selling businesses or stock. 10. Close struggling business units if they are unable to produce acceptable returns. The Outsiders, 8 Unconventional CEOs Conclusion, Relevance of the Lessons. We've covered 8 standout CEOs and their companies, mostly in the latter half of the 20th century. But how applicable are the lessons here? Are they still relevant in the modern day? And are the lessons relevant for small businesses or managers? The author argues yes to both. New section, Modern Relevance. The author argues the principles in this book are timeless, studying 2 examples, prepaid legal and Exxon. Modern example, prepaid legal. Prepaid legal, known today as Legal Shield, provides legal insurance for a fixed annual premium. Customers have their unexpected legal costs covered, including expenses for litigation, wills, and trusts. Growing quickly through the 1990s, its revenue flattened. Despite the lack of revenue growth, its stock price grew by 4 times. How did prepaid legal achieve this? As you might expect, the answer came in its capital allocation decisions. They optimized free cash flow. Recognizing that the industry was mature and further investment would likely have low returns, the CEO instead repurchased shares aggressively, buying back over 50% of shares. The company sold for $650 million to private equity in 2011. Modern example, Exxon. From 1977 to 2011, ExxonMobil showed a 15% annual return for investors, exceeding the overall market and competitors. The cause, once again, was intelligent capital allocation. ExxonMobil maintained discipline around requiring a minimum 20% return on projects. This meant some contrarian decisions, such as pausing unprofitable production during low energy prices, even when Wall Street analysts complained it reduced short-term financials. They repurchase shares when it seems economically profitable, buying back 25% of shares in a recent 5-year period. They made acquisitions patiently and opportunistically. For over a decade, Exxon hadn't made a significant acquisition, until it purchased Mobil in 1999, a transaction worth half its enterprise value. They enforced a company culture of frugality, returns, and low ego. The CEO Tillerson rarely interacted with Wall Street or industry conferences, avoiding the spotlight to focus on the business. New section, Relevance for Everyone. What if you're not a CEO of a large public company? Are the decisions relevant to everyday managers and business owners? The author argues yes, what's shown here is a rational approach to capital allocation. Figure out the value of all the options available to you, then choose the most profitable ones, ignoring conventional wisdom and what your competitors are doing. Here's a realistic example. Imagine you own a single location bakery, and you have more demand than you can service. You consider 2 possible options: 1, expanding your current store; 2, opening a second store in a new location. Using the checklist of the outsider CEOs, work through the following steps. Determine your personal hurdle rate for investments. Say it's a 20% annual return on investment. Calculate the costs of both options. 1. Expanding your current store might cost $50,000 for a new oven and $50,000 for renovations, for a total upfront cost of $100,000. 2. Opening a second store might cost $50,000 for a new oven and $150,000 for new building expenses, for a total upfront cost of $200,000. Calculate the additional profits enabled by each option. 1. Expanding your current store allows you to service the existing demand that you currently can't serve. You estimate, after operating costs, expanding will net $20,000 in additional profits. 2. Opening a second store lets you access more demand than your current store, but there is also risk in misestimating demand. You estimate, after operating costs, opening a second store will net $40,000 to $75,000 in additional profits. Calculate the ROI of each option, and compare to your hurdle rate. 1. $20,000 in additional profits over $100,000 in upfront costs is a 20% return. This just meets your hurdle rate. 2. $40,000 to $75,000 in additional profits over $200,000 in upfront costs is a return between 25% and 37.5%. This is a higher return, accompanied by higher risk. Consider the major assumptions in your understanding of the situation. How confident are you in the sales estimates for your second location in a new location? How might you be wrong about this? Opening a second store requires $100,000 more investment than expanding your current store. How can you access this capital? How much will it cost? Are there any qualitative benefits to the new store? For example, does it better build capabilities to pave the way for future expansion? Does it diversify your revenue so you are less dependent on your current store? Even though this example concerns a relatively small business, it uses the same thought process that CEOs of Fortune 500 companies use. And by going through this decision methodically like outsider CEOs, you'll arrive at the optimal answer for your situation regardless of what conventional wisdom tells you to do or what your competitors are doing. The Outsiders, 8 Unconventional CEOs Exercise. Consider your outsider management. Reflect on the patterns found in outsider CEOs and how they might apply to your management. Question 1. What are some of the most surprising habits of outsider CEOs that you don't do yourself or you don't see commonly done? Question 2. Outsider CEOs saw their primary job as capital allocation. How could you improve your approach to capital allocation? Question 3. Outsider CEOs were unfailingly rational in their approach to strategy, examining all their options quantitatively and choosing whatever was best at the moment. How can you improve your approach to strategy in this way? Question 4. How can you be more independent in your thinking as a manager?